Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Commercial Metals Company quarterly report. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Commercial Metals Company offers a diverse range of businesses and services across the globe. At its core, the company manufactures, recycles and fabricates steel and metal products, including ferrous and non-ferrous scrap metals, finished long steel products, semi-finished billets and fabricated rebar. The company's product offerings extend to various industries, such as construction, where it provides reinforced bar for buildings, hospitals and infrastructure projects. It also caters to the energy market with special bar steels and armor plates for military vehicles. Additionally, Commercial Metals Company sells and rents construction-related products and equipment, including wire meshes, welded steel mesh, wire rod, cold-rolled rebar, and assembled rebar cages. The company's services include processing and selling scrap metals to various consumers, such as steel mills, foundries, aluminum manufacturers, and copper refineries. It also manufactures and sells strength bars for the truck-trailer industry and provides fabricated rebar products to fabricators, manufacturers, distributors, and construction companies. Overall, Commercial Metals Company is a comprehensive provider of metal products and services, serving multiple industries and geographies through its three segments: North America Steel Group, Europe Steel Group, and Emerging Businesses Group. The Commercial Metals Co. (CMC) stock price has experienced a significant increase of over 52.7% in the past year, from $47.98 in January 2025 to $74.87 in January 2026. Several key events and company performance highlights have contributed to this substantial rise. One major factor was the strong fiscal Q4 2025 results, where CMC reported net earnings of $151.8 million, exceeding analyst expectations. The company's consolidated core EBITDA increased by 33% year-over-year, reaching $291.4 million. This performance was driven by expanding North American steel product metal margins and record results from the Emerging Businesses Group. The strategic acquisitions of Foley Products Company and Concrete Pipe and Precast also played a significant role in CMC's stock price increase. These acquisitions are expected to generate $165–175 million in EBITDA for fiscal 2026, positioning CMC as one of the largest precast businesses in the United States. Additionally, exceptional fiscal Cone 2026 earnings beat further fueled investor confidence. The company reported net income of $177.3 million, a 200.9% rebound from a loss in the prior year period. Adjusted earnings per share reached $1.84, significantly surpassing Wall Street expectations. Analyst upgrades and price target increases also contributed to CMC's stock price rise. Several analyst firms upgraded their ratings and increased price targets for CMC stock, further fueling investor confidence. The company's dividend announcement in January 2026 reflected its confidence in cash flow generation. Overall, the combination of strong financial performance, strategic acquisitions, and improved market conditions has driven Commercial Metals Co.'s stock price increase by over 52.7% in the past year. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the positive side, net sales increased by $210.7 million in 2025 compared to 2024, indicating a significant revenue growth. The North America Steel Group and Europe Steel Group also showed an increase in revenue, with the latter growing by 0.1%. Additionally, raw materials, steel products, and downstream products contributed to revenue growth in various segments. The CP&P acquisition and Foley acquisition were also key contributors to revenue growth. Furthermore, changes in average selling price per ton, tons shipped, metal margins, and acquisitions all played a role in driving revenue up. The increase in steel products metal margins within the North America Steel Group segment was particularly significant, leading to a year-over-year increase in net earnings. However, there were also factors that contributed to revenue decline. The North America Steel Group declined by 0.6%, while downstream products and construction products experienced revenue decline in various segments. Excess capacity in the industry, competition from other materials or lower-cost competitors, global factors such as trade measures, military conflicts, and political uncertainties all took a toll on revenue. Currency fluctuations, availability and pricing of raw materials and electricity, and lower than expected future levels of revenues, and higher than expected future costs also contributed to revenue decline. The net income of a company underwent a significant transformation between 2024 and 2025. Initially, the company incurred a substantial loss of $175,718,000 in 2024. However, by 2025, this loss was converted into a profit of $177,282,000, marking an impressive increase of $352,999,000. The improvement in net income can be attributed to several factors that positively impacted the company's profit margins. Firstly, the North America Steel Group segment experienced increased metal margins for steel products, contributing to higher profits. Additionally, the recognition of a federal investment tax credit related to the construction of the West Virginia micro mill also boosted earnings. Furthermore, the effective income tax rate decreased significantly from 24% to 3.1%, resulting in lower tax expenses and higher net income. However, there were some negative factors that affected profit margins. Changes in litigation expenses and potential payment uncertainty led to a decrease in profits. The exact impact of these changes is not specified, but they are acknowledged as contributing to the decline in profit margins. Overall, the combination of increased metal margins, tax credits, and lower income tax rates resulted in improved net income and profit margins for the company in 2025. The company has demonstrated a consistent trend of generating positive operating cash flow over the past 2 years. In both years, the operating cash flow was substantial, with figures of $204,187 and $213,024 respectively. Furthermore, estimates for 2026 indicate that this positive trend is expected to continue, with an estimated operating cash flow of $625 million. While there is a mention of a reduction in operating cash flow, it does not necessarily imply a negative outcome, but rather a decrease from the previous year's high levels. Overall, these figures suggest that the company is generating sufficient cash from its operations to support its growth and financial stability. The company's debt level and interest expenses have undergone significant changes in recent years. The long-term debt has seen a substantial increase, rising from $1,310,006 to $3,305,262, indicating a considerable rise in the company's financial obligations. This trend is further supported by the data showing total liabilities increasing from $2,978,508 to $4,930,402. The increase in long-term debt has also led to an increase in interest expenses. The interest expense has risen from $11,322,000 to $24,848,000, a significant jump of over 119%. This increase is attributed to the higher debt levels and may continue to rise if not managed effectively. Additionally, capitalized interest for the 3 months ended November 30, 2025, was $4 million, an increase of $1.9 million from the previous year. The company's financial situation appears to be under strain due to its increasing debt burden. The significant rise in long-term debt and interest expenses may impact the company's ability to service its debts and maintain profitability. It is essential for the company to reassess its financial strategy and explore options to manage its debt levels effectively. Management's outlook for the company is optimistic, with several key initiatives underway to drive growth. The most significant development is the planned start of production at the new micro mill in Berkeley County, West Virginia, which is expected to begin operations in 2026. This expansion will not only increase capacity, but also reduce reliance on imports and tariffs. Management anticipates a favorable market backdrop for domestic long steel producers, particularly with the elimination of Section 232 tariff exemptions. While tariffs are seen as part of a broader program aimed at stimulating domestic investment and construction activity, their impact is expected to be modest due to the company's primary sourcing from domestic suppliers. The company's growth plan and initiatives are designed to provide benefits and capabilities that will drive future success. The TAG Operational and Commercial Excellence Program will be executed with a specific timeline, ensuring timely implementation of growth strategies. Managing costs and capital expenditures is crucial, as successfully integrating acquisitions and operating steel mills at full capacity, particularly during periods of domestic mill startups, will be key to achieving these goals. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done consistently over the past 2 years. In 2025, the company paid out $20 million to its stockholders, while in 2024, it paid $-20,000 and $-20,554 respectively. In addition to paying dividends, the company has also been actively buying back shares from the market. This strategy allows the company to reduce the number of outstanding shares, thereby increasing the value of each share for existing shareholders. In 2025, the company repurchased $38.9 million worth of shares, while in 2024, it bought back $50.4 million worth of shares. Concerns about inventory buildup and potential supply chain disruptions are evident in recent data. Inventory levels have seen a significant increase, with a notable jump of $16.7 million from August 31 to November 30, 2025. This is reflected in the rising inventory write-down, which increased from $8,950 in 2024 to $2,835 in 2025. Furthermore, raw materials and construction products inventories have seen substantial increases, indicating a potential buildup of stock. Additionally, there are concerns about supply chain disruptions due to various factors such as excess capacity in China, new steelmaking capacity coming online in the U.S., fluctuations in raw material availability and pricing, global public health crises affecting trade, and currency fluctuations impacting regulations. These issues highlight the need for companies to reassess their inventory management strategies and prepare for potential disruptions in the supply chain. By understanding these challenges, businesses can take proactive steps to mitigate risks and ensure a smooth operation of their logistics. That concludes the financial summary for Commercial Metals Company. Feel free to comment below, and I will be happy to answer them when possible.